Welcome to this edition of Annuity News Now. I'm Scott Drake. My guest is known as a national expert on the topic of annuities. His name is Stan Haithcock. As a matter of fact, many refer to him as Stan the Annuity Man. Stan, it's a pleasure. Welcome.
I appreciate that. Actually, I am not. I mean, people don't even know my last name. You're the first person to bring it up in a long time. So, Stan the Annuity Man is the company. StanTheAnnuityMan.com is the site. And yes, we only specialize in annuities. I've burnt the boat, and this is what we do.
Well, annuities have favored pretty well in this past year. Let's talk about things like low interest rate environments and volatilities in the market, and how you think this will impact how they do in 2012.
Well, I think from the annuity industry standpoint, from the standpoint of product offerings, it's going to be a challenge with the 10-year Treasury being at 2% or less. I think you're going to see a lot of companies kind of reel in some of the benefits and lower them. You're going to see a lot of the commissions start being dropped as well, and that's fine. I mean, I think the industry has to make sure that they're, backing up the guarantees of the products. And I'm going to kind of go out on a limb here and say that, in the John Hancock and Sun Life vein of carriers getting out of the variable annuity business, I do think you'll see a lot more carriers kind of exit the variable annuity business because of some of the exposures of the riders that have been in place out there. And there's been some improper selling of the riders. And I think going forward as an industry, we have to hold ourselves accountable to make sure that we explain that a rider can only be used for income or only be used for long-term care, and it is not a walk-away amount. That's one of my pet peeves that I run across a lot, that people think that they're getting that number as yield when we all know it's for future income.
So talk about the income riders in particular. They can be kind of complex and kind of hard to understand. Is there a lot of education that needs to happen here?
There's a ton of education that needs to happen on the riders. I think that is the biggest. If you ask me one thing that we need to work on as an industry, it's explaining the riders. I think we could do it very simply with people if we would just tell them to take a piece of paper, draw a line down the middle of the piece of paper. On the left-hand side is the walkaway amount. On the right-hand side is the rider or the benefit amount. And they're both unique. They're both separate calculations. But for the income rider side, I think it has to be explicitly explained that this isn't a yield number. This is a number that will compound during the deferral years. You can use it as a target date income planning method for years down the road. And it does work when it's positioned properly within a portfolio, but it's not yield. You cannot walk away with it. And we run across a lot of situations where that's not been properly explained. So, riders are perfect when they are explained to the client and positioned properly. I just think as an industry, we need to slow down when we're talking to clients and explain the fact, hey, the 10-year Treasury is at 2%, the rider is at 6% or 7% or whatever you're selling out there, and say, listen, here's how they're doing it. Okay, this isn't a walkaway amount, but we can use it for income down the road because, most people's fear is outliving their money.
Right. Talking about that in particular, I mean, a lot of people right now who are looking at retirement, they're in the income phase, for example. Everybody, is talking about fleeing to safety because the equity markets are kind of volatile. How do, I guess in general terms to the consumer, how does an annuity fit into this picture?
An annuity needs to be looked at as a transfer of risk product. So in essence, annuities solve for four things, primarily principal protection, income for life, legacy, or long-term care. So the acronym is PILL, P-I-L-L, Principal Protection, Income, Legacy, Long-Term Care. So if you need to solve for those situations, you're going to try to find a carrier that's going to solve for that contractually, not in a hypothetical, contractually. What does the contract say? What does the policy say? And then you're going to transfer the risk to that carrier to do that. For instance, if you want a lifetime income stream for you and your wife, you're going to pick an immediate annuity in this case and say, okay, here's my money. We want you to pay us for the rest of our lives, and we're going to structure it so that no money's left on the table for the insurance company. It'll all go back to the beneficiaries. That is a transfer of risk type product. Same type of product if you said, I want to solve for long-term care. You're transferring the risk to the carrier for them to pay for long-term care type coverage. Or if it's a legacy situation, same thing. So I think the three key words is transfer of risk, which is really what annuities are.
Can you talk a little bit about FIAs or fixed index products? Those are gaining a lot of attention now because obviously there's an upside potential here, and those who have been in the equity markets are going, well, if I can save, you know, my principal and still have an upside, that's going to be great. Can you talk about their application?
Absolutely. You know, one of the things that the equity index annuity side is a great product if positioned properly. One of the things that we're seeing out here is they're being sold as a panacea. You know, you get all the upside and none of the downside, and we all know that that's not true. You get limited upside, you get none of the downside, you do get lock-in values, but that needs to be explained. But for people that are looking for principal protection, participation somewhat in the market with some upside but not a ton of upside, equity index annuities work perfectly. I just think that as an industry, we need to kind of reel in the hypotheticals that people show to clients. For instance, on the monthly sum type calculation, if the cap is 2% every month, I don't think agents should be out there saying you could get 24%. Let's look at the realistic returns, the Wharton returns of 4 to 6% on average for equity index annuities. I think that's great, and I think if it's explained, you know, in a reasonable manner to a person, say, here's how it works, here's what you expect, and frame their expectations in a realistic manner, people are going to love equity index annuities, you know, from the standpoint of fees. And if you compare them side by side to, say, variable annuities, it's actually more cost efficient to place riders on fixed index annuities than variable annuities, just looking at them side by side.
Mm-hmm. It sounds like you are, you know, in favor of having a lot more transparency, even perhaps it sounds like even more regulation. Is that correct?
Absolutely. We need more. I think we need more. We need, you know, coming from a person who doesn't want a lot of government involvement, annuities they need to be regulated from the standpoint of how people present them. I think the qualifications of who are selling them, you know, I'm not sure where that goes, but I do think that a lot of people that are selling, for instance, fixed index annuities don't have the background in the financial services industry or in the financial services part in general to even be qualified to talk about money. That's just my opinion. I mean, my background is I came from the wirehouse industry with Morgan Stanley and UBS and those type of places. Annuities fit in a portfolio. They should not be sold as all of the portfolio. It's a portion. You know, it's almost a non-correlated asset on the fixed side.
And then finally, in closing, let's have you talk to the advisor out there. What are some of the things that they need to consider here in the new year as the landscape is kind of changing a little bit?
I think advisors need to reframe how they look at what they're doing. Instead of trying to think about how much premium you're writing or how many inner circles you're trying to get or how many trips you're trying to go on, I need you to reframe things. Why don't you look at it and say, how much income contractually are my clients receiving on a monthly basis? How much legacy have I put in contractually that my clients are going to receive down the road? How much long-term care? How much target date income? Reverse it. Look at your practice and say, how much income or how much in dollar benefits have my clients received contractually or are receiving contractually, and then build upon that. And when you go see clients, you say, listen, here's what I do. You know, I solve problems. I solve problems contractually. I transfer the risk, and here's the bottom line of what I'm giving to my clients. And what I'm giving to my clients is contractually this amount of money. For instance, for me, my clients on a monthly basis receive over $3 million in income payments every month, month after month. I have over $250 million in legacy contractual guarantees in place. I've got over $20 million in long-term care contractually in place. I've got over $5 million a month in target date income that's going to kick in 5 years from now and beyond. I know exactly what those numbers are for my client. I wish as an industry that we would look at it more because that's what we're bringing to the table. We're bringing peace of mind. We're bringing lifestyle. We're bringing transfer of risk. We're bringing, you know, nights that they don't stay up worrying about the market. That's what we do. So let's stop looking at the industry as how much premium did I write. Let's start looking at how much benefits did I give.
And in this new age of technology, from a marketing standpoint, do you think social media, online, the internet plays a significant role in that marketing?
I'm not sure. I think we're early in the game with that. I still think at the end of the day it's a face-to-face contact sport where you got to sit at the kitchen table, look at the people in the face, At the end of the day, we're talking about people's money. But I do think that the social media is going to be more of a foundation for the person to maybe get to know the advisor better and understand who they are. That's where it's going to be for probably the next 2 to 3 years.
All right, Stan, a great pleasure. Thank you so much.
You take care. I really appreciate the time. Call anytime.